All right, welcome to The Explainer. Today, we're talking about sectoral credit analysis. When you look at a bank, what you see on the surface, that's just the tip of the iceberg. We're going to dive into a powerful technique the pros use to spot the hidden risks, the ones that everyone else misses. So, here's a question for you. How can two banks have exactly the same numbers but totally different futures? I mean, it's a classic puzzle, right? They look like twins on paper, same profits, same performance metrics, but one is cruising along just fine and the other, it's heading straight for a cliff. The crazy part is, the answer is hiding in plain sight. Okay, just look at this. Bank A, Bank B. Their return on equity? Identical, 15%. Their bad loans, what we call non-performing assets? Both a solid 2%. I mean, on the surface, you'd say they're the same company. But here's the kicker. Look at where they're actually lending their money. Bank A is all in on real estate. Bank B, they're focused on consumer durables. And believe me, that one little detail, it changes absolutely everything. And that brings us to our first big idea here, what we call the identical bank paradox. It's the perfect illustration of how headline numbers can totally fool you. The banks look the same, right? But their fates are tied to completely different sectors of the economy. If you really want to see what's coming, you can't just look at the P&L. You've got to dig into the bank's real engine, its loan portfolio. So the big question is, how do we actually look deeper? Well, that's where our main topic comes in, sectoral analysis. Honestly, the best way to think about it is like an analyst's magnifying glass. It's the tool they use to slice right through all the noise in the financial reports and see what's really happening inside a bank's loan book. So what is it exactly? To put it really simply, sectoral credit analysis is all about figuring out a bank's risk based on which industries it's lending to. I mean, think about it. $1 billion loaned out to, say, real estate developers is a totally different beast than $1 billion loaned to a bunch of grocery chains, right? The risk profile is completely different. So it's not just about how much money is out there, it's about who has it. And that focus on who has the money brings us to a quick tour of sector risk. Because here's the bottom line. The fundamental truth of this whole explainer, not all lending is created equal. It's just a fact. Some parts of the economy are way more volatile and way riskier than others. It's helpful to think of it like a spectrum. On one end, the high-risk end, you've got these really cyclical, volatile sectors. Think real estate, think massive infrastructure projects. Yeah, the potential rewards are huge, but they are super sensitive to any kind of economic shock. Then, way down on the other end, you've got sectors like consumer durables and retail. They tend to be much more stable and predictable. Let's just take real estate for a second. Why is it so high risk? Well, think of all the things that can go wrong. A big project can get totally derailed by stuff that's completely out of the bank's control. You could have construction delays, cost overruns. What if market demand just evaporates? Or the government changes the rules? Or the big one, interest rates suddenly spike. Any single one of those things can flip a great-looking loan into a disaster overnight. Okay, so we know different sectors have different risks, but how does a real analyst actually piece this puzzle together? Well, they don't just guess. No way. They use a super disciplined step-by-step process. And that's what we're looking at next. The analyst's framework. This is how they systematically find that hidden risk. And this framework has 5 key steps. First step, you analyze the portfolio composition. Basically, what's actually in the loan book. Step 2, you do a sector-specific risk assessment. How risky is each of those parts? Then, step 3, you overlay geography. Because let's be real, a real estate loan in a booming city is a world away from one in a struggling town. Fourth, you do a historical performance review. How did this stuff hold up in past crises? And finally, number 5, you do forward-looking stress testing. You ask, what if these go really wrong, and see where it breaks? And that first step, figuring out the composition, it's absolutely crucial. Seriously, this is where the real detective work comes in. A bank might say on paper that it has a nicely diversified corporate lending portfolio, but a sharp analyst digs in and finds out that, whoops, 60% of that is actually loans to real estate developers, just in disguise. So what looks safe and diversified on the surface is actually dangerously concentrated. And that leads to a really important rule of thumb that analysts use to spot trouble. This is a big one, so listen up. If you see that a bank has more than 15% of its entire loan book concentrated with just one single developer or business group, that is a massive red flag. Huge. It means the bank's entire health is basically tied to the fortunes of one single customer. Super risky. All right, let's add the final and maybe most crucial layer to our analysis: riding the economic cycle. You see, a bank's loan portfolio doesn't exist in a vacuum, right? It's completely tied to the health of the wider economy. And in this game, timing is literally everything, because some sectors are going to boom while others go bust, all depending on where we are in that cycle. And you can see a really clear pattern here. Think about it. When the economy is recovering, everyone's feeling confident. People start buying cars, new appliances, so those consumer sectors do great. They're the winners. But what happens during a downturn, a recession? Well, everyone tightens their belts. Spending goes down. The new winners are the defensive sectors like healthcare or government-backed loans. And the laggards? You guessed it, real estate and those risky unsecured loans. So imagine you take all these layers we've talked about, the real composition of the loans, the risk of each sector, the geography, and the economic cycle, and you put them all together. What do you get? You can build the ultimate tool for an analyst, a sectoral heat map. It's this incredibly powerful single visual that shows you exactly where the hot spots of risk are hiding in that portfolio. So let's wrap this up with your new checklist for thinking like a pro analyst. First, you've got to understand the risk profile of each sector. Second, you have to dig deep and map out the true portfolio composition. Third, you analyze that geographic concentration. Fourth, you put all of that into the context of the economic cycle. And finally, you always stress test for what could happen in the future. Okay, so now you have the framework. You know how the pros look past the headlines to see what's really going on. So I'll leave you with this question. Thinking about this, what institutions out there in your world might just be a whole lot riskier than they appear?